I'd like to introduce the panel. Lindsay Creedon is a partner and head of diversity inclusion at StepStone Group. AJ Hernandez is a director of emerging managers, is the director and head of emerging managers at New York State Common Retirement System. And Ray Whiteman is the co-founder and managing partner at Stellex Capital Management. As Sansia has indicated, the topic of emerging managers is a critical one for the Robert F. Kennedy human rights, and increasingly so far, the industry, given the interconnection of diversity and capital allocation for those fund managers. We have three industry leaders who cover the allocator, manager, and consultant sectors to share with us how they and their clients are approaching the topic in the wake of the past year of protest and actions on racial and economic disparities due to COVID-19. So let's start by setting up a ground rule as relates to emerging managers. AJ, as head of the Emerging Manager Program of one of the largest pension plans and actually one of the largest emerging manager program, I would like to ask you, how do you define the category of fund managers that are emerging?
Thank you, Marvin. Quite simple. So we look at emerging managers in two ways. We look at emerging managers as managers that are relatively small, typically under $2 billion, a little bit over 100 million. And in terms of sort of secondary to that, we look at managers that are MWBE, or minority and women, minority or women owned, 51% specifically.
Okay, and how, when you look at them, when do you outsource and when do you look to consider it as a direct investment by New York State teachers? I'm sorry, by New York State Common Retirement.
So now that's a great question. So, you know, traditionally, the way we've done our investment, it has been through program partners. So we use 8 different program partners across the different asset classes, from private equity to real estate to global equities. And you know, in the beginning, as we were putting together the platform, we thought that was the best way to, you know, to enter the space. You know, over time, what we've been looking at is to go more of a hybrid approach. You know, the issue has always been resources. How do you work with a small manager that you're typically investing anywhere between $10 to $20 million, and then you have your core program that are investing anywhere between $200 and $300, $400 million? You know, you typically have to have something, have to have a separate emerging manager program like the one that I run. And you know, quite frankly, when it comes down to it, you know, most of the managers that come through our program go through these programs, our external partners. Now, most recently, we have been focusing on more of a hybrid approach, you know, being able to look at managers on a direct basis, very similar to what we did with Ray Whiteman. But, you know, it's still strategically, it really means that I have to grow my team in order to be able to underwrite and analyze each manager. It takes a long time. Ray Whiteman was our first. I think Ray was at his wit's end. It took us, I think, almost 18 months. We got a little bit better. We just closed 2 weeks ago on another manager that we will shortly announce. That one took us 14 months. So we're getting better on a direct basis, but most of our managers that are relatively small, over $100 million, typically go through our program partners.
Thank you. Lindsay, your role intersects with managers and limited partners, and you also lead diversity at StepStone. How do you define emerging managers, and does this align with what you hear from your limited partner clients?
Sure. So, when we're working with our partners, there's, as you noted, there's different definitions. It can be, AUM based. Some are defining it as, a fund 1 or 2, and some are specifically focused on, minority or women owned. So it can take different definitions and flavors. When we think about it at StepStone, we have integrated it into our diligence and investment processes as well. So when we're going out and doing diligence on, any manager, whether it's the smallest manager or the largest, we're asking them all about their diversity statistics on their investment team as a firm overall. What does their ownership structure look like? What does their compensation structure look like? And so we've seen people kind of define diverse anywhere between, 25%, 33%, 50+%. But what we're looking to do is to really track that, get those statistics, and then be able to look at it over time. Because, there are some firms that are very young and they're kind of just starting on their journey. And we want to say, how are you focused on D&I right now? What does it look like? What's your roadmap to get from, A to B to C, et cetera? And then we're able to really track that over time. Because, as AJ mentioned, and as was discussed on the previous panel, this is an increased focus. And I do think when we talk to emerging managers, they are, despite their size and their smaller size from obviously their kind of, much, larger, more established peers, they focus on, D&I issues and ESG issues, much earlier on. And they're usually much more laser focused on this, whether it's around, building their team and making sure they're building an inclusive culture and a diverse team. It's something that they're very focused on from the get-go. So, I would say, we work with our clients very much on an individualized and customized basis. So we're working with them on kind of how they're thinking about what emerging manager means. But again, it's something as we do our diligence, we're very much focused on in our assessment and analysis of a manager.
Thank you. Are you finding more of your clients now are interested in diversity? What do you see, and what do you advise your clients with reference to that?
Absolutely. I mean, I would say, AJ was talking about how, I think emerging managers could get very frustrated as they're raising capital. It can take a long time. It's a process. So we will, on the one hand, part of what we do is when we're meeting with emerging managers and building a relationship, talk to them about what to expect when you're going through a fundraising process. And that can be from DDQs, presentation materials, just how to kind of set up your organization. But we've also had managers come to us to say, we're a small firm. We haven't really had a formal focus on D&I in the past. Can you help us build a roadmap? And we'll sit down with them and kind of talk through the different things, whether it's around how to broaden your funnel to attract talent, or, through retention. Because you see that, when you look at diversity at the junior levels, it's, 30% in private equity. That drops to 20-25% at the mid levels. By the time you're getting to the senior and the partner level, I mean, you're talking about, maybe 10%. And so how do you retain that kind of talent as well? So we'll work with managers to kind of think through that. And it's a conversation, right? So when we're doing, diligence on a manager, we're kind of seeing where they are now. We want to see that they have a very kind of intentional, authentic focus on these issues. And then, as we kind of monitor and diligence them in a few years' time or whatever it may be, we can really track that progress. And that's something that we have really institutionalized in our process and in our databases to be able to kind of capture that information.
What normally happens is a client of yours, as I understand it, would call and say, we met with such and such emerging manager, and we'd like you to do the due diligence. How do you sort of take that situation versus an emerging manager? How does it come to you for advice if a client of yours doesn't recommend you to take a look at them?
If a client calls and says, we met, with this emerging manager, we'd like you to take a look at them. I mean, when we do the diligence on emerging manager, it's going to be, very similar in the sense from an established manager. So we're going to do all the same kind of analysis around the team, the strategy, the track record, operational due diligence. We're going to look at, ESG and score on ESG, D&I, all those types of things. But I think, when you're doing diligence on emerging manager, it's one thing that's beneficial to kind of having the broader network are, one, you will rely on, I think, reference calling a lot more, right? Because it's usually maybe a new team that's spun out. Maybe they were previously at other organizations. So being able to kind of do reference checks, kind of on and off sheet reference checks, I think is important. And to be able to have insight into their track record prior to establishing their new firm. So that would be something that we would very much integrate into our diligence, but we would have the same process in terms of wanting to have an on-site. Before that would have been in person. Now that would have been, over Zoom or digitally, but we want to have a full on-site. So we go through the same process. There just might be kind of, other points of information that we need to rely on a little bit more heavily for emerging manager versus a very established player.
Very helpful. Ray, you've raised 2 successful funds and have been in front of staff, boards, and vetted by consultants, similar to what you just heard with reference to StepStone. Do you believe emerging manager programs are relevant and needed, and what can be done to improve them, to improve the emerging manager programs from your experience?
Very good question, Marvin. And first off, thanks for allowing me to participate in this. It's funny because I go back with RFK to my grammar school, which was named after Robert F. Kennedy. And it was a special program set up in Brooklyn that really changed my life. And so just from that perspective, the whole nature of a program like that is critical, much like the emerging manager programs, that we have today. I think it really comes down to people really understanding the whole architecture of the industry with, 90 trillion out there, of which less than 2% are managed by MWBE. So obviously without emerging manager programs, it probably would have been less than 2%. Probably substantially less than 2%. So that's one thing. They are a necessary part of the whole industry, because it really allows smaller, newer managers to get some visibility. Obviously, jumping into the ability to get into core programs is very, very hard out of the box. So a lot of times we have to start in the emerging manager programs, and I think that we need these programs. We need them to get bigger. I think they're really necessary, and people need to understand that these emerging managers, if you look at the data, the returns that are being generated from them are better than the more established firms. People are hungrier, they have something to prove, and generally funds 1, 2, and 3 generally outperform the larger firms. So this isn't a social program. This is about giving access to groups that have been inherently shut out from the asset management business. And I think it's clear when you look at the returns that it works and it makes sense. I think from my perspective, we need more of these types of programs to give people a shot to get into the business. Obviously, when it's 98% white men in the space, we need to kind of really take a good hard look at that, especially when you look at a number of the public plans and their underlying constituents who are, if you look at, say, any police department, 30 to 40% are going to be, minority in any of the major cities. So, it really is tying the money management side to the underlying constituent in a much closer manner. I think it's really a plus. I think people should think about expanding it, and there's a lot of good that's come out of it, and it just gives people that opportunity to get into the business. Whereas if you're trying to compete against a firm that's been around for 20 years, it's much harder to kind of displace them or even get noticed by any of these major plans.
Marvin, can I just add to that?
Please.
Look, I agree with Ray. There's still a lack of diversity in diverse firm, which represents a small fraction of the total asset management industry. And to Ray's point, there's $71 trillion that's controlled by that is currently controlled by the asset management industry. And to his point, only 1.1% of the total assets are with firms owned by women and minorities. And I think that was a report that was recently released by the Knights Foundation. And what does that tell me? It's that there's an inherent bias towards smaller and diverse managers. And the truth is, it takes programs like mine and of my peers to have vision and help managers establish themselves. And quite frankly, the smaller managers, as Ray said, are hungrier and willing to go the extra mile. And and that's why there is a discernible correlation in asset managers between outperformance and size. I just wanted to make sure that I just added that because I 100% agree with Ray.
Well, let me ask you one question. It appears as though you are increasing the amount of diversity investment, increasing various programs in areas of private equity like credit and things like that. Do you find that, in your opinion, the industry understands that the returns are generally greater for the smaller funds and the ones that are diverse and are really hungry? Do you think that's getting out more in the industry?
Yes, and the answer is yes. As of 2020 brought to light a lot, and it kind of pushed forward many programs like mine to the limelight, and also shined a light on many pension systems, endowments, foundations, consultants to focus on smaller and diverse managers. And it's just going to take more education, I think, versus what has been done in the past. But people are much more focused on it today. So, I would say, yes, the message is getting out there, but we just need to continue the message and, kind of not let up.
Do you
and to echo on AJ's point, Marvin, I think there's, again, some of it goes back to this whole notion of emerging manager programs being social programs. We are here as an emerging manager to make money for the LPs. End of story. And when you look at the returns and you really rack and stack, the returns speak for themselves. So this isn't just a socially acceptable program. This is about how do we generate alpha for our underlying constituents. So I think that's one of the things that people have to get a grip on, is that this is about making money for the LPs. And, and yes, we just happen to be female people of color that are doing it.
Yeah, I will say, just to add on is, you know, there aren't different standards, like from our perspectives when we're doing diligence. You know, you're looking for the same kind of returns, very strong risk-adjusted returns. Obviously, your diligence process might be a little bit different. You're not going to be able to look at 20 years of a track record, but there are other things that you can look at. And I think people are starting to realize that, you know, the returns are there. And it is just a case around emerging managers, or when you have the discussion around D&I in any organization, it's not that it's like it's a social good or it's the right thing to do. It is, but it makes business sense as well. And the data has proven that out. So I do think it's just kind of continuing to push that and continuing to have that education. But, you know, we're very clear the standards are not different. We're not lowering the standards to execute on these kind of programs.
Thank you. AJ, have you found that some of the funds that you funded early on have become larger funds? Can you give us some sense of the growth of some, you can name them or not name them, but the growth of some of the funds that were really, let's say, a lot smaller that have become a lot bigger because they were backed in the emerging manager programs?
Excellent question. So I can say that we have had well over 25 graduates from our program that are now all multi-billion-dollar funds, from all the way from private equity to real estate to global equities. So what our capital does to many of these managers, it basically catapults them. Many of these managers use the capital to build the infrastructure, to invest in great investments, and they, you know, like to Ray's point, to Lindsay's point, you know, these folks who are graduating into the core program have all performed. They have done very well. There are others in my program that choose to remain small because their strategy is relatively small. So, their focus is very niche, so they tend to be small. But that's not to say that if they wanted to grow, they wouldn't grow. It's just that they decide to keep their funds relatively small. But I've had successful managers take the capital that we've invested with them as LP, or even you know, as a GP interest, and grow the platform successfully. Have done very well for us, and have graduated into the core program, which just makes our core program even better.
There are some people in the industry, and I would love your comment because I think they're wrong, but that say that a number of the big allocators say they're investing a lot of money, but they give so much to the top 15 or 20 that have graduated. Can you give us some sense of what you're allocating in the lower end, or let's say first or second time funds that are smaller? Are you increasing that?
So we continue to increase our allocation to the emerging manager program. I mean, when we first started back 10 years ago, we were just, you know, we made an initial investment of $200 million into private equity. We're now at $7 billion, and we're continuing to increase our footprint, not only with our program partners, but we're also going direct. So we're taking a good hybrid approach. I suspect that, you know, having the hybrid approach, that would get us, you know, closer to $8, $9, $10 billion in short order. In terms of fund managers that represented by that capital, I would say 50% of the capital that we're investing, actually, excuse me, 60% of the capital that we're investing are first-time fund managers or second-time fund managers. And the capital that is going to be used to go direct will be first-time fund managers and potentially, second-time accelerated capital for second-time managers.
Thank you. Lindsay, do programs differ across allocators dependent on the type of institution? So is it different for pension plans, endowments, and is it different geographically in the US versus Europe or elsewhere? What have you seen?
Yeah, I mean, I will say, some investors are, like what AJ was saying, they have a separate program, because I think for a lot of the larger pensions, their commitment sizes or their check sizes are normally just too large for emerging managers. So they have a separate bucket where they can kind of size down to be able to access those types of opportunities. So I say they're normally kind of structured as separate programs. We do have some, I guess maybe kind of smaller, that they would just integrate it into their core program. So they would, and they will have different definitions of what emerging means, but that it is more integrated into their core program. So they have the ability to do those smaller check sizes. It just depends on kind of like obviously the size of the client and how nimble they can be from that standpoint. I will say from like a US versus, Europe standpoint, I don't know if there's, a ton of differences. I mean, I think the EU, we've talked a lot about, emerging manager, what's the definition, and diversity. I think in Europe, we generally see a heavier focus on ESG and impact. So I think that there is definitely a stronger focus there. But in terms of how the mandates are structured, not a huge difference. I will say that, I think from a diligence standpoint, for those trying to access kind of emerging managers or smaller managers, they are more used to kind of, remote diligence or not meeting someone necessarily in person. Obviously, COVID has sort of taken that differentiation away. And I think, the term, democratization of access has emerged, just kind of given everybody is doing things over Zoom. But then I also think from the manager standpoint, when you look at the EU, just the passporting process and some of the kind of regulatory processes have made it a little bit more difficult or even more daunting to try and kind of access, investors in the EU. But I will say, we do see, in Europe, a very, an even heavier and more intentional focus on ESG specifically.
Thank you. Ray, the racial protests of 2020 elevated the dichotomy that still exists in the industry between emerging managers and managers of underrepresented minority groups and women. What has been your experience in the past year related to this? Are diverse managers getting more investments by allocators in your fundraise? Did you have more people interested? And are you able to have any advantage because of your diversity in purchasing companies? Any light you could shed on that question?
Sure. It's funny, Marvin, when we launched raising the second fund. Now, going back to the first fund, it took us about 3 years to raise that, actually over 3 years, 3.5 years to raise that first fund. We launched our second fund in January of 2020. And, we were over at Super Return, and we could definitely see what was coming because everyone was focused in on what was going on in Italy. And by the time we got back from Berlin, the world shut down. And we just said, okay, well, we've done a 3.5 year fundraise. I guess, we're going to be in it for the long haul. And what happened was pretty interesting. Obviously, with some of the issues that was going on in the U.S. There was a huge pivot. The U.S. allocators opened up much sooner than what we saw in Europe. 6 weeks in, the thaw started, and obviously with what was going on with Breonna Taylor and George Floyd, all of those issues really started to galvanize folks to really start taking a look at the industry and their allocations. And literally, we had our first close in May, and we were essentially done fundraising by the end of June. So, which totally shocked us. But I think, there was a big pivot, and the U.S. moved much faster. There was an admission of, when we look at the asset management business based on those statistics, there's something fundamentally wrong, and maybe this is some of the opportunity to start to address some of that. As we look at the businesses today and what we're looking at, Stellix is a certified minority business. We see that as an advantage as we look at certain niches in the industrial space, which is where we like to play, and essentially anywhere that has sizable contracts or tied, or have some sort of government nexus, that becomes a competitive advantage, and we've started to exploit some of that competitive advantage that we have as we look at certain industrial businesses that that have that government content to it.
Thank you.
Marvin, I just want to add just one thing to raise a comment is that, part of the reason that he was able to raise his second fund so quickly was because he performed. I mean, the first fund has done phenomenal. Not to put you on the spot, quite frankly, the investors including us, we got very comfortable very quickly.
No, that is ultimately, as everybody has said, one of the most important ingredients in the whole thing. Lindsay, do you have any comments that you want to make on that, the racial protest of 2020 elevating the dichotomy?
I know, except that I think there's just much more of an intentional focus on it. It's something that we are much more focused on internally and looking at ourselves, but also in our managers. I think we talk about it's all about performance, but these are linked. Having a diverse group of people around the table, looking at an issue, looking at investment, analyzing risks, you're going to have a much better chance that they're going to either see an opportunity, analyze a risk differently, have a better discussion, come to a better decision than a group of people, that all, kind of come from a very similar background or have the same perspective. So I think it's something that's just got really bubbled up in the conversation. I will say, now versus maybe 2 years ago, the amount of time that is spent in conversations with managers and in diligence and in on-sites on D&I issues, on ESG issues is far, far greater than it was previously. So, it is like, top of the list topic of a conversation, when we're talking to managers. So I just think the conversation has been elevated quite a bit in the last year, which I think is a great thing, and I think it'll continue.
Okay. Today there are a number of state pension plans, there are a number of foundations that are sort of outsourcing. They're looking at and making decisions as to what emerging managers they should invest in. What advice would you give any of the new people who want, if they came to you, that want to get into the emerging manager space? What advice would you give them the LPs? What advice would you give anybody that wants to get into the space? AJ, why don't you go first on that?
You have to be purposeful when you're going into the emerging manager program. There is an ecosystem. I would take the time to talk to the various systems that are running a successful program. Understand what makes their program successful. Some programs are doing it on a direct basis. You should also be talking to folks who are doing it on a direct basis, because everybody's going to approach it slightly differently, and it's going to really depend on sort of the internal organizational structure. So you have to find what works for you. And once you find what works for you, you really do have to have purpose. You do really have to have a long-term plan on how you're going to grow the emerging manager program. What are the milestones that you're looking for? Just like the core program, you do have some managers that don't hit the mark. Does that mean that the program needs to shutter? No, it just means that it's just part of the overall process. So you have to be thoughtful about what it's going to look like, how you're going to grow it over time, how the due diligence is going to be done, how you're going to graduate managers. So, and quite frankly, you also have to, take the time to understand whether or not you're going to have a dedicated person or a dedicated team, or this is just going to be integrated into the individual asset class. So you really have to spend time really seeing, taking all of that and seeing how it's going to work. But I think you need to have purpose. You need to make sure that if you're going to be in it, that you stay, that you definitely jump in and get help. There's a lot of trade organizations out there that we work with, from your Twigo Foundation to your NASP to NAIC to NAA to Tide to Accelerated Investor. There are so many ways that you can also access the emerging manager space so that you can get educated on what's the best way to also source managers. So I'll leave it at that.
Thank you. Sansia, I just got your direction that we ought to start a question and answer.
Yes, Marvin. I do have some questions that have come in, some of which the panelists have touched on already, but this theme of due diligence for emerging managers, particularly as we know that it was already a more thorough and more rigid and even lengthier due diligence process as an emerging manager. Maybe just circling back on the point around how has that changed in the past year with the impact of COVID, and how are the panelists viewing that change? Will it continue into the next year? Do you imagine sort of going back to your 2019 approaches even around that due diligence process? So it would be good to hear from AJ and Lindsay, but certainly from Ray, having gone through fundraise and certainly knowing a lot of other emerging managers in the industry, talking a little bit about that. And then Ray, there's a specific question for you that has come through. You're a minority-owned business, you're a minority-owned fund, and if nothing else, there's been this re-emergence and heightened attention on underrepresented minorities in the industry in light of so much that's happened in our society in the past year. And so the question really is asking, how are you as a minority-owned fund approaching the topic of diversity in your organization, and inclusivity even in your organization, and specifically on investment teams? Because one of the things that we champion within RFK Compass is that the pathway to CEO and the pathway to the decision making, the boardroom really is led by a sales and finance track. So if you are on the investment team, your chances are even higher of getting into that leadership and decision making role. So how are you thinking about your investment teams and the companies in your portfolio from a diversity lens? So those are the two big questions.
Okay, maybe I'll start off with the latter one first. As we think about diversity within a firm like Stellex, look, it's something that obviously we live and breathe it every day. They see me, they know what my personal goals are as far as creating an extremely diverse and talented team. What we're seeing is, as we look out as how we continue to attract talent, I want it to be additive. I don't want to go to another minority firm to take someone to put them on my team. And what we're seeing is that the numbers coming through the banking system has gone down, and that's been the real funnel. So what we're doing is we're going after undergrads now to recruit them. We're in discussions with a number of the HBCUs. We're going to set up our own program and bring them in direct into as analysts, and then let them graduate to associate, and then continuing through. Because we what we really see is that there aren't that many folks even that are either at other firms or that are even in the banking programs that really kind of funnels that skill set into what we need to do. So we're going to have to create our own, and that's what we've really been focused in on. And if you look at our firm, that's one of our key attributes that we are focused in on. We have investment professionals that are female, that are white, that are Asian, that are African American, and Indian. So we are, it becomes part of our DNA and culture, which makes it easier to kind of continue. And when we kind of put this on paper, that was one of the stated goals, which makes it easier if you come in with that mindset, as opposed to having to change people's thought process around what it should look like. And I think that's where we've really focused in on, by putting it on paper, really driving through, and then just pushing it through the system and building a culture that the predicate is, it is going to be a diverse firm.
Right, absolutely. I don't know if others want to tackle the other question that came through, but sort of drilling deeper into that due diligence process and it being already arduous in some and lengthy in some parts pre-COVID, and how much of that is still the case now, and how much of the COVID pandemic is continuing to influence that due diligence process, and the challenges that diverse managers have historically faced. I don't know if Lindsay or AJ have any, sort of
Sure.
thoughts there.
Sure, I can start. I mean, I think that what Ray was talking about with his fundraise, I will say we were surprised at how quickly just overall the industry pivoted when COVID hit. We kind of were looking at the data all through last year to see, how many funds raised, how many hit their targets, how many hit their hard cap. And overall, I mean, I think investors kind of learned a lesson after the GFC and when they sort of maybe stopped investing. And I think for the most part, we saw LPs stay the course through COVID. But when you kind of drill deeper into that and you looked at, larger managers, mid-market, established managers versus small buyout, emerging managers, you did see, a little bit of a bifurcation in terms of, emerging managers and smaller managers, having a harder time in terms of having to extend, their fundraising timelines or being able to hit their targets. And I do think it was, the fact that you couldn't meet anyone in person. And when you're trying to when you're up and coming and trying to establish those relationships, it was just harder over Zoom. I do think people have gotten a lot more comfortable, doing due diligences on Zoom, establishing relationships, over Zoom or whatever platform you're using. So I do think that there's been positives and negatives. Again, like, the last panel, they were talking about just the democratization of access, the fact that, as an LP or as an institution, you're now able to meet with so many more people that previously you would felt like, well, I need to travel or they need to travel, or you actually have access to a lot, you can meet a lot more people now. So it has leveled the playing field. So I think there have been pluses and minuses. And I think, what Ray was talking about, just kind of back on the diversity point, I think the same thing, that COVID has opened up so much, because at StepStone, we've done the same thing. We started going direct to undergrad, building, internship programs, partnering with organizations to build internship programs that then can convert into full-time roles, but just being able to access so many more colleges and universities. Because when you look at the banking program and you look at kind of the more, the historical way people have gotten into our industry, it's pretty narrow and a certain group of colleges and universities where a lot of people come from. And now we're able to do fireside chats, set up mentoring relationships, establish relationships with a much, larger group of colleges and universities, and tap into students that we probably never would have gotten to meet, and explain, who StepStone is, what private equity is, what are the opportunities. And I think it's really, I think it's been, an opportunity as well to be able to do that. So, it's a long way of saying there have been pluses and minuses, but I do think that there have been some pluses, just in terms of being able to access things that you haven't been able to access.
No, the only thing I would add to that is that, in terms of the due diligence process, it definitely took longer to get comfortable. And I do feel bad. There are a handful of managers that I've been underwriting at the moment, and it took longer simply because it was we didn't even have policy on what are we going to do in this case. It was straightforward before, where we just needed to go on site, do the on site due diligence on the investment side, on the operational side, and over time, as as we got comfortable with Zoom and it was here to stay, we started putting policies in place to be able to look at a manager, a new manager, and be able to put capital to work with a first time or a second time fund manager. So it took some time to get comfortable, but now it's just part of the course. And I think as we get as we see it on the other side, post-pandemic, I think having the ability to do both Zoom and on-site dramatically sort of shorten the overall due diligence process.